The background material for that 1.5-day meeting was 857 pages, which is probably about 800 pages too many to cope with over that time period. So this complexity issue is real, and there's a risk that, as with the tax code, that you're in this interminable loop of having to layer complexity on top of complexity to cope with new loopholes springing up. So there's an issue there. How much is really necessary, and is there a case for a distinctly Asian approach? I don't know the answer to that. But what I would say is that currently Asian banks are to some extent disadvantaged by the apparatus as it is. And the reason for that is that Asia has a larger number of smaller banks that are using simpler, so-called standardized approaches, not these complex models, somewhat simpler methods. That is good. The less good thing, however, is that if you use those approaches for the same exposure, you may have to hold multiples of the capital of a large bank that does have this complex apparatus. So this feature of the regulatory framework advantages the large banks over the small. It advantages the incumbent banks over the new entrants. And it advantages the rest of the world, broadly speaking, over Asia. And none of those features are ones I think we'd view as desirable features of a competitive and contestable financial system. Is there a way of closing the gap? I think there is. Is that closing of the gap underway? I think the process has begun, but has a long distance still to travel.
Do you think, just following up on that, do you think how can that be accelerated? What are the catalysts that will help the acceleration of that, the closing of the gap?
Well, I think there's part of the responsibility resides with regulators like me in making the case for fewer than 857 pages. Some of the case rests with the banks, and you heard Stuart this morning discussing some of these issues. And some of the responsibility rests beyond finance. Because ultimately, let's be clear, the costs of this complexity aren't felt by me, and they aren't felt by the banks either, actually. They're felt by you in the charges that are levied for the loans that you receive or the payments you wish to make. So I hope the longer term, as with the tax code, there could be an alliance of interest between regulators, the financial sector, and wider society to have something that's closer to being fit for purpose. What we have is a massive improvement over where we've been, but can we and should we do better? Yes, we can, and yes, we should.
Thank you. Stan, if I can ask you a question.
Sure.
I think hard not to bring up the comparisons between the 97 and 2008 crisis, given your roles at the IMF and the Bank of Israel during those two periods. What real progress do you think has been made in terms of an international regulatory or even policy framework following those two crises?
Well, I think the 1997 crisis was not in the center of the global financial system. It was in Asia, and it wasn't in the biggest countries of Asia either. I'm not sure that there was an understanding. There was an understanding that things had to be done fast. And my sense is that, I want to ask Mr. Koo a question in a moment. My sense is that it looked very tough at the time, and it was very tough. But part of the reason that Korea got out of the crisis so quickly was that it dealt very quickly with the finance companies that were in trouble there, and got it over with, and didn't get into a Japanese-style lengthy period of trying to deal with this problem. The one country where the whole thing broke up was in Indonesia, where I think that in the Indonesian case you had a very much more complex problem which related to the ethnic composition of the business sector, and the fact that Suharto was ill and eventually resigned. And there's a profound loss of confidence of the business class, particularly in the economy, which led to massive capital outflows to Singapore at that time, and that was a more complex case. I think the lesson that I at least took from that was you better get these things done fast. And I want to ask Mr. Koo a question, if I can do that. You know, the 1980s were known as the lost decade of Latin America. You talked about saving the American banking system. Was that done at the expense? Would Latin America have done better if that process had taken 3 years instead of 10?
Then the US taxpayers probably would have to be part of the picture. And that could have complicated things even further, given how American taxpayers react to this kind of issues. And maybe Paul Volcker did not want to get that part involved, because that could actually lengthen the process instead of shorten the process. And if you look at, you mentioned about Korea coming back quite quickly, but Korean won fell 73%. And once the Korean won fell 73%, Koreans could export their way out. And that same thing happened in Nordic countries in the early 90s too. They were small enough, no one was paying attention, currency fell 40–60%, and they were all able to export their way out. But that was not an option available for big countries. And that's why I think this time around, US, UK, all these countries are taking so long, because we really cannot export our way out when everybody has the same problem at the same time.
Well, I don't agree with that. I think that the damage done to the financial systems of the United States, the United Kingdom, was far more significant than what was done in Latin America at the time. I mean,
but if US tries to export its way out, what will happen to the rest? Everybody else tried to export their way out, and we're back in the 1930s. So that's why there was an emergency G20 meeting in Washington, D.C., November 2008, so that no one would engage in that kind of activities. And from the Japanese perspective, I want to come back and say that Japan was the only country that followed that agreement in November 2008 in Washington, D.C. Everyone else trying to undermine that agreement by backdoor quantitative easing. And that's why Japanese yen became the strongest currency in the world for full 4 years, with a huge cost to the Japanese economy. Now they're saying, okay, you guys did that to us 4 years ago, let us do it now. And that's why the Japanese are bringing exchange rates down.
Mr. Koo, I asked you a question about Latin America in the 1980s.
Okay.
Not about the United States in 2008. So the question was, if the United States had been willing to pay something to keep its banks whole, which was to inject some capital in 2 or 3 years at the beginning of the crisis, would Latin America have been better off?
Well, I'm sure that would be, if that was possible, I'm sure that would be better for everyone. Because there would be more capital to the global banking system that needed capital. And it was not just the American banks that were hurt. All global banks were hurt in that way.
Right. From which one raises questions about the benefits of having an international banking system.
That I fully agree. Everybody thinks they are diversifying, but everybody tried to diversify at the same time. You don't have a diversified system.
Maybe, Richard, I can continue. In terms of Abenomics, it's assumed to have the 3 arrows, fiscal, monetary, and structural. What about the regulatory angle? Is the regulatory a 4th arrow?
Oh, I don't think that's in the discussion. But what we have in Japan is this huge distrust between the FSA and the banking system for the following reason. I mentioned in my talk that in 1998, 1999, we had a capital injection. And capital was injected on the understanding that that capital would be used to support lending, not write off problem loans. Because the problem loans are so large, if that was used to write off problem loans, it won't last more than 20 minutes. And so that's how the arrangement was made. But a couple of years later, the government changed, and this finance minister by the name of Mr. Takenaka said, hey, how come we are sitting on such a large problem loans? Let's clean it up. And that was a completely against the complete betrayal of the original agreement. And there was a huge problem during those few years between the FSA and the banking authorities. So after that, the relationship between the FSA and banking system deteriorated to the point where in 2008, when we had a Lehman shock, Japanese banks also ran into a lot of problems. And the government at the time quickly put together a capital injection program, a very efficient capital injection program. Not a single Japanese bank applied for it. It says, you lied to us last time, you betrayed us last time, we're not going to do it this time. And so it was actually Bank of Japan that had to come up with this very convoluted, subordinated whatever loans to the banking system to keep banks going. And we are just coming out of that lack of distrust between the two, the banking system and the FSA. And the two are coming closer now, which I think is good, but that's the challenge we face in Japan at the moment, that there's not sufficient trust yet between the two sides.
David, I think just going on from your exceptionally entertaining and informative speech, I don't think I can ever go to Capital Airport again and not think about Modigliani and Miller. So I think in terms of the changes from the third-party plenum on the SOE side, how do you see these reforms in terms of, do you see them as a watershed in the role of SOEs versus the market in China? And again, the implications of that on the financial system?
You asked a very difficult question. It makes me feel that you have read that booklet a couple of times. Because actually, in this document, I think the reform measures for SOEs are not that well or strongly articulated. I think the SOEs in China are facing challenges, and challenges in a way that the governance structure was or needs to be enhanced. And many of the SOEs are working under the premises that as long as they can, pay the salary, pay the costs, pay the interests on their debts, they don't really have accountability to shareholders. Because if they earn too much profits, someone else wants to come in to become the CEO of that company. If they earn too less or don't make profits, then they will lose their job. So in a sense, it's not an efficient system. So I think with that backdrop, we really want to see a real reform in the SOEs. And that SOEs for non-financial sector as well as for the financial sectors. A couple of areas we want to promote more. One is certainly corporate governance. The second is talents and train real business people to remain in the business, not go to take up job in the government. I will embarrass Chairman Liu. Chairman Liu Mingkang is such a wonderful banker. He led the reform of Bank of China in Hong Kong, and then set up the foundation of Bank of China to moving on. But he was taken away from the bank to be the chairman of the CBRC, and the government has to take away his all share options in Bank of China Hong Kong, was 10 millions of Hong Kong dollars. We should have a system not established, to train people to go to the government. We should have a system that retains the talents in China. At PW, in the business in China, our company recruit students, 10,000 a year from the university graduates. Now the students, the number one job is going to government. Number two is going to the SOEs. Number three is going to people like Goldman Sachs, who really pays well. And number four, they're coming to us. So there must be something wrong, So what I really want is we have a system to retain the talents in the real business. And there's perhaps not an answer. Perhaps Professor Fischer has an answer. But I want to push that way. I'll leave that.
I'm not sure at what stage you want to have a discussion on the panel, but I'll ask a question and you can rule it out of order. I've been trying to think of what the fact that the numbers you're attesting to are not the right numbers from an efficiency viewpoint. And I was thinking of, 10 years ago or so, the Chinese government injected a lot of capital into the banking system. And somehow the banking system revived, or at least so it seemed from outside. So what was happening there? They enabled the banking system to operate, to extend more loans, given the rules, given the accounting rules under which it was operating. But presumably the answer then was, but the loans they were giving at that stage were hopelessly not efficient, or possibly not efficient, because they were based on values which were book values and not market values. Is that what was happening? And is that what's happening today?
That's a question to me?
Yeah, or to anybody, yeah.
You want? Richard, you want to start?
Oh, the Chinese banking system, it's your field.
You've got China, David.
I think in 2002, 2003, 10 years ago, as you say, we helped the government to understand, the real problems of the banks, because technically the Chinese banks at that time are all bankrupt. So we actually helped them estimate the bad assets problems and then find the solutions. And then, actually we carved out the non-performing loans and then start to introduce strategic investors. And then before that, actually recapitalized. $45 billion was injected to Bank of China and the Construction Bank of China, and then strategic investors, and then IPO. And you're right, those money into it, actually just a part of the money to recapitalize the bank. And before that, all the problem assets are actually carved out or washed against the government's equity in that company, in that banks. And because it's a very determined approach of clean up the balance sheet. So as long as the banks raise hand and say this is a bad asset, the government take it away. So you see that from 2000, after this reform, after the clean up, the balance sheet actually relatively clean, and it keeps up to today. And the government's money flowed into it, of course, growed in the real economy. But your question, I think, which is very valid, is partly I addressed in my talk, is that the lendings are actually slew to state-owned economies and slew to the government-sponsored projects. So the credit risk on the balance sheets of the state-owned banks are actually government itself. As long as the governments are sponsoring that, their balance sheets are relatively clean. So I think we talked about in some other sessions that how, in the government policy as well, in China, whether we will have a commercial arrangement for exit of bad banks in China. And then the government is thinking about introducing deposit insurance and all those mechanisms. I think that is a very short history in a bank from 2003 to now, but there are lots of lessons to learn. Professor?
I think at this point, with sort of 10 minutes or so left, can I open up to the audience for questions?
Thank you very much. This is a question for Andy. You heard Professor Fischer say that the UK got the regulatory system wrong in the late 2000s. Certainly that's a view around this region. And my bit of Asia, which is India, the RBI would say, look at those Westerners, they liberalized too early. We are far smarter than they were. There's a Brahminical type of approach. What learnings and advice would you take from the financial crisis in the West that might be relevant for a country like India as it thinks about liberalization?
So this is a question for which the answer is potentially career-threatening, so I'll speak carefully. I think I couldn't do any better than to underscore what I took to be the essence of Stan's response, actually, which is be humble about any regulatory structure and the promise it holds. When I think back over the sweep of the Bank of England's 319-year history, the key thing you need to do, design-wise, is brace yourself for failure. Because like a bad football team, in regulation, you can only lose or draw. And occasionally you will lose. And an interesting question is, how resilient are you when things don't go right? That's why I think that underscores the importance of us having a regulatory apparatus that permits orderly failure. Because if we're in a world where commercial bank failure is inevitably umbilically associated with regulatory failure, then we're forever doomed. So we need to break that link between the two, and that means having arrangements that allow, hopefully, even the biggest banks in the world to be resolved in the language that we use in a way that doesn't imperil wider society, and thinking parochially also doesn't imperil the regulator. If we have that, it gives us a fighting chance. If we do that with the requisite degree of humility, it gives us an even better chance.
I'll test my possession of the microphone and ask 2 short questions because I'm curious about the second as well as the first. The first is for Mr. Haldane, second for Mr. Koo. In the book, The Banker's New Clothes, the authors recommend a simple high level of requirement for capital. They say this risk weighting of assets doesn't work, and I tend to agree with that. I'm wondering whether you think that's a reasonable recommendation and whether there's a possibility it would be workable. The second question is for Mr. Koo. In that time, 1979 to 1982, when you were trying to get the banks to not loan to Latin American military dictators, did they say, well, who do you propose we loan to then? Well, that was a time of influx of petrodollars and so forth. They had to do something with it. So those are my questions.
So on to the first, let me link it back to something David said actually about complexity and the difficulty of valuation, which is by no means specific, as we know, to Chinese banks. This is a problem for many of the world's biggest banks. So, I mean, let's just think about the scale of that problem. We have, imagine valuing a portfolio of assets whose scale was roughly the annual GDP of a mid-sized G7 country. I mean, that's what we're talking about. That's a tricky portfolio to value, not least because some of those promises, some of the valuation requires on clairvoyant skills about how the fortunes of the real economy might pan out over the next 20 years. That's a difficult valuation task. How much margin for error would you want to give yourself, given the complexity of that task? Well, right now, we're giving ourselves, once the new rules are in place, we're giving ourselves a 3 percentage point margin for error on that portfolio whose size is the annual GDP of a G7 country. And how does that make you feel? Do you feel comfortable about that or not? And Nat and Martin's conclusion is that that doesn't feel especially comfortable because we've seen the asset values of those banks in question vary by very much more than 3 percentage points, particularly in situations of stress, which is why we find banking systems jumping to situations of systemic insolvency. So I think that is the essay question, and the book you mentioned provides a pretty clear answer, both that we might want to give ourselves a little bit more margin for error, and secondly, as importantly, that providing ourselves with that insurance cover need not come at any real cost to the wider economy over the medium term. So, I mean, as put, the case sounds reasonably compelling, I'd say. Is that where we'll head over the medium term? I mean, time will tell, but I think analytically at least, the case is well made.
I'm so glad that you paid attention to that part of my comment, because I inserted that comment, 1979 to 1982, the New York Fed was warning American banks to be careful about Latin America, as an example of a situation where regulators knew what was happening, what was coming, and was issuing all the warnings, not like the 2008, but at least in that instance, we were warning the American banks every week that you're doing something crazy. But they just refused to listen. They doubled the exposure, and based on this guy's comment from the Citibank by the name of Walter Wriston, who said companies go bankrupt, but the countries don't go bankrupt, so the countries are good risk. And what do you do in an instance like that, where the regulators know what's coming, but the markets refuse to believe it. They keep on going in this crazy direction for full 3 years, destroy themselves, and then the regulators, in order to save the banking system and the economy and so forth, have to mend the damage. And that's one of those dilemmas for the regulators. I mean, we really wanted to shoot those guys August 1982, but we had to do the reverse. We had to save them to save everybody else. So that's one of those issues for regulators to think about. What do you do when you see things coming but the banks don't listen? What kind of powers can you exercise in the situations like that? Now, I'm sure Chinese banks or the Japanese banks who do listen to the authorities don't have this problem as serious as in the US, but it is a serious problem. And on the second part of your question, what we would have recommended for them to lend? That was actually also a very difficult period for American banks as well. And that was because securitization, capital market were becoming much more accessible to US companies. And so banks were losing their traditional customers to the capital market. And if the traditional corporate customers were still there, I'm sure they wouldn't have lent it to that, well, at least they wouldn't have lent that much to Latin America. But because they were losing the traditional clients, they had to find something, and they ended up lending to those borrowers. I don't think we recommended them to lend to someone else. I don't think we were in that business as a central bank. But it is true that that was a pretty difficult period for American banks because they were losing business to the capital market.
I think perhaps let's end just with a single statement from each of you. I think if you just one single piece of advice you could give Asian regulators, what would that be? Stan?
I sort of have a problem with advice to Asian regulators as opposed to regulators. And I don't know what the special problems are. I mean, we've had a very clear description of the problems of Chinese regulators relating to the origins of this banking system and how it got to where it got. Incidentally, I usually describe what happens with this as fiscal policy. The government tells the banks to lend here or there or somewhere. If they get into trouble, if the loans go well, that's fine. If the loans didn't go well, then they'll put some capital in and clean it up that way. So it's in essence, it's a way of getting spending done and investment done without running it through the budget in the first place. So that's a very special setup, but if China wants to, and actually should want to, develop a more modern banking system and a more market-oriented banking system, then the regulators will have to be pushing, if the regulators have the power to do that. Now, I think LMK did that. At least that was the impression we all had, and that's generally viewed. So it seems to be possible. But you still have somewhere in the system the orders to lend in particular directions, and some of the orders which are given are very expensive in terms of doing the wrong thing or creating later costs which are very large. And so there'll be a battle for the regulators to try and get commercial conditions or real business conditions or lending to be on a business basis and not on a window guidance, which was the Japanese phrase 20 years or so ago, I think, for that type of lending. Well, that's China. It's not the same story, I assume, in say ASEAN, in many of the countries of ASEAN, Korea, and so forth. So it would be to go along with what's happening in the recommendations of the Financial Stability Board and the Basel Committee, because we'd all love to have a really simple rule. All you need is a liquidity ratio, or all you need is a high capital ratio, and everything else goes. It'll never get there. That's just not going to work, because with everything, there'll be detailed questions about how do you count the capital, how do you count these loans, where do you get the capital requirements from, how do you estimate them. All that will be around, so it's always going to be complicated. And my guess is that, knowing that Andy Haldane sits in those meetings trying to simplify things, that at least they're as simple as somebody like Andy can make them, and if anybody can make them simple, he's sitting right here with us, and I don't think there's a simplicity much beyond where we are now, although it's very, very difficult to believe that this is the very best we can do. But I guess it's close to the best we can do at the moment.
So David and others discuss a lot the benefits of further liberalization in China, but many of the same arguments apply elsewhere across Asia, and I completely understand those arguments. They make perfect sense, and they will deliver many of the benefits that David and others have discussed. But the words David used, I think, were government is not smarter. As someone who works for the government effectively, I can only endorse that sentiment. But the fact is, government doesn't need to be smarter, because government, or the state, offers something different. And two of the most important of those things are, one, patience, and second, coordination. And I think both count for a lot when it comes to finance. Both count for a lot when it comes to the financial sector. I think liberalization is fine, it delivers a lot, but it can come at the cost of a lack of patient capital if you are not careful. And we need to think about whether the regulatory framework and the role of government is sufficient to ensure that we have the patient capital that's necessary for businesses to grow. And second, on the coordination side, the financial cycle, the risk-taking cycle, is every bit as regular as the business cycle, except its amplitude is much greater, and the costs of the busts are that much greater. And we cannot afford to live through another financial cycle of benign neglect, of leaving it to take care of itself and mopping up the consequences ex post. We've seen that movie, and it ended in disaster. It resulted in a cumulative output loss that is unprecedented since the Great Depression. So the financial cycle needs to be managed. It will not be managed because it is created by the private sector. It needs to be managed proactively by government or regulators. It is not enough to mop up after the flood, because these floods will drown you. If there's one lesson of the last 5 years, for me it is that.
Well, given what I said about American banks from 1979 to 1981, I think you know that I don't believe that markets are always smarter than government either. So government's not always smarter than the market, but markets sometimes go crazy things. And so I think we have to be vigilant on both sides, that if the market is really going berserk, then central banks, monetary regulators have to put in necessary stops to make sure that they don't really go overboard. And if the crisis does start, then I would recommend that regulators look at the situation and say, is this a 95% problem or 5% problem? If it's a 5% problem, you can do all the typical things, clean up the mess and so forth very quickly. And during my term at the New York Fed, we had Continental Illinois Bank going bankrupt. But that was a very isolated case with very isolated factors behind it. So we were able to just ring-fence Continental Illinois, nationalize within 48 hours, and then we could move forward. But not the Latin American debt. This was a much more difficult problem, and we had to manage this for full 7-8 years until Brady bonds were able to come into play. And so I hope that regulators here will have that determination at first. And if it's a 95% problem, I hope you have necessary regulatory authorities so that the bureaucrats who are thrust into that position don't have to guess whether this is okay to do or this is not okay to do. That under those circumstances, these powers are available for you, please use it right away. You know, if you have that, you can react very quickly. And in the banking crisis, the kind of that crisis that I've been involved in, 20 minutes, 2 hours can make huge difference. And so if you have those rules, then you can move forward. If you don't have rules, then you have to check with your lawyers what is possible, what is not possible, and then you could lose very important critical hours during the process. So I hope you have those provisions in place just in case private sector goes crazy. And private sector does go crazy every several decades, and those are, of course, what we know as bubbles. And when bubble starts, they're usually with some good reasons, but then it becomes self-eating and then becomes the monstrosity. Then we have to clean up the mess afterwards. If we could stop the bubble from happening, if Greenspan recognized those housing bubbles earlier, I think we would have been all better off. But at the time, he was the one who was denying that there was a bubble when all these congressmen and senators in U.S. Capitol were saying this is a bubble. And then if the central bank says, no, it's not a bubble, then you're going to be in for a big problem. But that's the macro issue. But once the problem happens, there should be necessary powers available for the regulators to handle it.
Thanks, Richard. I think just for time, I think a big thank you to all the panelists for an excellent session. And I think we'll wrap up and finish at that point. Thank you. Thank you.